MarketSite. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me, we have John Frank. He's the QQQ strategist over at Invesco, and Nasdaq's own David Gideon. He's the head of research and product development for Nasdaq Global Indexes. And we are here celebrating the 20th anniversary of the Qs. Thanks so much for joining us here at MarketSite today. 20 years. Who would have thought the second most actively traded ETF in the US? Give us a little bit of background.
Yeah, so QQQ started 20 years ago, and it tracks the Nasdaq 100, so the 100 largest stocks that are on the Nasdaq exchange, excluding financials. And it's really had a great track record. I mean, launched right before the tech bubble, so an interesting time to launch a fund, but even through that, it's actually done enough to outperform over the long period of time. And it's a fund that is also liquid, so it's for people that trade, they can get exposure at minimal cost. And for those that want the exposure, they can get long-term performance that has done very well.
All right, now Dave, speaking of, this came around just before the tech bubble. You have tracked three major tech themes.
Yeah, definitely. And the thing with the Nasdaq 100 is, especially when we look at it now over the last 20 years, it really has been the bellwether of what the new economy has come to represent. And if you think about, we go back to the mid to late 90s when sort of the Y2K was driving a lot of the technology investment at the time, there really wasn't an understanding of what technology was to become. But with the beauty of indexing and being rules-based and always selecting the 100 largest non-financial securities on NASDAQ and the type of companies NASDAQ has attracted into its market over the past 2 decades, this index has really represented what we've seen of a massive change in technology. And if you think about 2003, so this is after the tech crash and really the bottoming out post-recession coming off of 2001 as well, what came out was the iPod. And the iPod, yeah, great. It's music. You get to listen to the Beatles or Rolling Stones or whatever it is that is your fancy. Obviously, you're still using a compact disc to load it onto your computer to then transfer to your iPod. But really, when you step back, what it represented was storage. What it represented was actually more of what is to come. And because in our pockets, in our hand, were just gigabytes of data. And that was something that we had never really experienced before at that type of scale and really that type of price point. And what that really drove was just a massive amount then of subsequent innovation, subsequent product development, technology development, because we were able to now store, we were able to have bigger programs, better graphics, and that started to sort of really lead into what we saw in the next time, which was, oddly enough, Wi-Fi. And it's not really what Wi-Fi is in the fact that you can have Ethernet around the world and such. It's more of what it represented, which was mobility. Our understanding that wherever we are in the world, whether it's a cafe, whether it's a diner, whether it's at work, we're going to pick up a computer and do work. And that is, really, manifesting itself in the type of products and the type of companies that we're starting in that 2005, 2007 type of era, really Web 2.0, which laid the grounds for just a massive amount of growth across market cap, across companies, across revenue. The biggest companies in the world today really came from that period of time. And then we get into the communication side. So this is now, think about 2011, 2012. When we go back, it's not that long ago, only 6-7 years, but that's really when FaceTime came out. That's when the ability to communicate around the world in a visual way came. And so now we had an expectation that no matter where we are, no matter where we're working, we're communicating. You're in contact. You're always able to be in contact. Now, there's some downsides to that as you answer emails 24 hours a day and get FaceTime from your boss every once in a while. Not ideal, but it's really sort of a massive economic productivity. And when you factor those three elements together, again, storage or data, Wi-Fi with mobility, and then communication or networking, you can start to see why so much of the economic growth has been driven by these technology companies. But the thing that's been great about it is that it's economic growth driven by tech companies, driven by the companies of the Nasdaq 100, but it's influencing all sectors. It's influencing all aspects of our life. So whether it's a better plane to be able to fly from Perth to London nonstop and not suffocate by being in the air for 20 hours, whether it's more fuel efficient cars, whether it's cheaper drugs, better drugs from preventing and curing cancer, that's all being driven off of technology. Right. And that's why we've seen such amazing growth, and as John referenced, some really phenomenal performance over the past 20 years.
Right, and also when you think of the Nasdaq 100, you typically think of tech, but there's so many different types of industry that it's really truly representative of what the American and global economy is. But let's take a step back and talk about the industry in general and the relationship between passive and active, because that's always going to be a hot debate within this space.
Yeah, I think you've seen over the last 20 years, so when QQQ was launched, the ETF structure was newer and thought of as an innovation. And I think since then we've seen the industry really explode and take off, and so many of these funds have gained assets over the past 20 years. And I think for investors, there's a big question of is it too big, is it too small, is it at a point where it's dangerous? And one of the things we've looked at recently within US listed ETFs, when you look at all stocks on US exchanges, it's about a $26 trillion market. And you look at US equities, ETFs that follow US equities, it's only 6% of that. So the idea that how big the investable pond is for US equity ETFs, it's only 6% of the total universe. And I think some people think, what is that point where it becomes dangerous or it's too big? I don't know what the number is, but it's actually possible to go beyond 100%. So theoretically, you could have the ETF universe be twice as big as the investable universe. We're nowhere near that. We're at 6% today. So I think when thinking about how big it is and is it dangerous, is it potentially a recipe for disaster? It's, a lot of these questions no one knows the answer to, but right now it doesn't appear that it's too big.
Right. I mean, that's great growth potential if it's only 6%. So when we ask, is the ETF industry saturated? Is there what other new products can come out? Sounds like there's a lot of room to grow here.
Yeah, there's definitely room to grow. I mean, I think you've seen the product innovation over the last 20 years as well, but a fund like QQQ that has just stuck to its knitting and done the same thing for 20 years has really rewarded investors as well. But there's new opportunities for different types of growth as well.
Would you say the same for indexing?
Yeah, definitely. And I think largely there are a couple different things driving that. One, I mean, in the active versus passive world, so much of what traditional active management, when we think back to the old school name brand active fund managers, they really had a competitive advantage at the time. And it was great that they had that competitive advantage. They were able to harness it. They had access to data. They had access to company fundamentals. They had better information to be able to drive investment decisions. And what's ended up happening, and really it's been over the past 20 years, is that competitive advantage has disappeared. Is now with a subscription to Quandl and a MacBook, somebody can go and break down every single piece of fundamental data of every single company listed in the US and do that same exact top, bottoms up fundamental analysis to find a good value stock or find a good growth stock off of those traditional metrics. And more importantly, those metrics that once were working so effectively that active managers or hedge funds would use to really drive excess return, the world now knows. Mm-hmm. And so as soon as it's discovered, which is it's being discovered at the same time, the trade goes and that alpha is disappearing. And that's one of the big things that's really harming the traditional active side. At the same time, with the rise of passive, what we've ended up seeing is an immense creation of rules-based, objective, and transparent indexes or strategies that will then get deployed through the great wrapper of the ETF or all different types of wrappers as well, actually. But what that rules-based, transparent, objective is really doing is it's creating building blocks. It's allowing people to utilize these passive investments in a very active manner. And so that way, if you want to go take a bet on a particular sector or a particular factor or a particular theme, you have a liquid vehicle, you have a rules-based vehicle that is going to deliver out that core investment thesis over and over again because the rules are there. And as an index provider, I can create the rules, but I don't interpret them. I don't change them. I don't get to say, hey, the index methodology says that these 4 stocks are supposed to be the biggest, but I have a hunch that ketchup isn't going to be popular anymore, and so we're going to lower this weight. And that's something that the active managers were supposed to be doing and not, and passive indexes don't do. And so they continuously follow those rules, which I think over time has just created a really significant competitive advantage versus that traditional passive side.
Right.
Traditional active side, sorry.
Well, it's interesting, too, that you bring up Quandl because I feel like this explosion in alternative data also lends for more issuers to create more funds, for more indexing because there's so many new data sets out there. And as you had mentioned, it's all, how the fund managers are interpreting it and what fits their needs. So between, only 6% and the amount of growth that's there and the way they can use this data to create these new indexes, it sounds like it's a good recipe.
Yes, in the product development side, and Quandl as an alternative data set is a perfect example of that. There are so many more decisions that have to be driven off of new data and new analytics. And that just breeds more and more indexes, which will hopefully bring out more and more ETFs. And it's a positive thing, because to think about ETFs that are focusing on a particular strategy or index that's trying to benchmark a particular investment factor, things change over time. To say that the value factor, as an example, it has the same efficacy today as it did 30 or 40 years ago, it just isn't true. And at what point do we start to say, okay, maybe we need to redefine what we think of value, or what we think of a value company? And sure, yeah, there's Nobel economists behind it, the original factor, but times are changing, right. Things are different. And so we have to have that constant foot forward in product development and research to find what that next and new is going to be. And I think that will end up being embraced by investors who are seeking out that next era of return.
All right, and John, we'll wrap it up with you. What does the ETF space look like over the next 5 to 10 years?
Well, I think that's, if I had a crystal ball, I think I'd have a great answer. But I think in terms of what to see going forward, one of the trends we've seen for the last few years is this has really become the bull market people love to hate. And I think one of the reasons that you've seen some of the strong performance in a QQQ is because the companies are doing better than expectations. So I think if there's going to be negative sentiment out there, it actually paves the way to potentially perform better going forward. So we just hope that the next 20 years can be like the last 20 years, but we don't know what it's going to be like.
All right, guys, thanks so much for joining us at MarketSite, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.